Hi, this is Randy Finney with Right Side of the Chart, and this is video number 3 for Thursday, September 22nd, 2022. It is 2:03 p.m. Eastern Time as I start in the video, and I'm going to mix up a few different things here. I'm going to do a brief update on the equity markets. I think most of you would agree I've covered those pretty much ad nauseum today, pretty extensively. So I just want to point out this potential bearish pennant pattern right here on the 15-minute chart, a QQQ I just noticed. A bearish pennant is a very close cousin of a bear flag. I pointed one of those out back here. Bear flag, you take the form like this, a little rising price channel or a flag. You have three components. You have the flagpole, which is an impulsive move down to that, followed by some flagging, typically on declining volume. The move down is on higher volume, and then a move out of the flag, and that was a measured target right there. It didn't play out in textbook bear flag fashion. Usually you go on down, but you did hit the measured target to the button. The measured target is just simply, it's easy to do. Just take a trend line on your charting program, go from the get the entire flagpole, they had impulsive move down from where it began to the bottom part of the flag, which I just did there, and then you drag it, add it to the highest point of the flag before it breaks down, and that gives you your measured target. So you can see that one played out. And on this one, let's just do our measured target here. If it does play out, that's your flagpole, and that's going to project down to about, it's ripe. If it's going to break down, it will soon. It needs to soon, or it's no longer symmetrical or proportional, I should say, to the flagpole. In other words, it could morph into a bull flag like this, but then it gets too big. This is the right proportion, the size of that pennant to the and again, maybe it could be a flag as well. If you want to draw it that way, you want to go like this, take a little trend line and go that way, and you have a bear flag, 6 to 1/2 dozen to the other. Again, the measure targets work out the same, so that would take us down to about 267-ish. And what would that do to us on the daily chart? It would take us right to the previous lows, test the recent lows right there. All right, so that's one thing. And we'll watch that. Oh, and what you want to see, just like anything, it's a setup, it's a potential pattern, needs an entry triggered. If you're going to take it to, let's say, add to short positions, you want to see an impulsive breakdown. You want to play it safe, wait for a break of today's or the recent lows right there, and then the redder the better. So if you get a second follow-up candle, you can even add more if you wanted to scale into some shorts. And then you can just put a stop above the pattern in case it proves to be a whipsaw. All right, so that's that. Let me talk a little bit on, let me cover the currencies first, because that segues into gold and even Bitcoin. I want to talk on those. And then, time permitting, I want to do a quick update on the banking sector. That's interesting as well right now. I see some developments worth noting. Okay, gold. I haven't updated in a little bit here, but this is what it looks like on the daily chart. GLD, the ETF, tracks gold. This is a big level, 158. It's the bottom of buy zone. When we were in there, I said I could easily see the potential for a little false breakdown here. Now, it's not a false breakdown, but it's a breakdown. I said I'm going to give it room. If that happens with these strong divergences, I suspect we'll undercut it, and then it'll move back up, maybe a little trend line right there to pop as well, and that should be very powerful. Bear traps are powerful things because you get a lot of shorts sucked in, shakes out weak-handed longs when they see that support broken under 158, and then once it's recovered, those shorts get squeezed, start to get squeezed out, their stops are hit. So again, it's a setup, and as I believe I told you the other day, you don't take, you could take the breakdown. It's very aggressive, and you could certainly take it with a stop somewhat below, tighter stop, or you just wait for the recovery, wait for the bear trap to be a thing. Right now, it's not a bear trap; it's a breakdown. A bear trap is a false breakdown, a breakdown that then gets recovered. So there it is. Still liking that. And gold just can't catch a break because of the currencies. Gold will trade inversely to the US dollar. I've covered that many times in the past, many times, and shown you there's a unmistakable and nearly immutable inverse correlation to gold and the dollar. Now, there are times where that can disconnect briefly, but over time you can go back 100 years if you want, and it's simple because gold's priced in US dollars. So when the dollar's moving up, it's taking more dollars to buy an ounce of gold. Of course, that's if you freeze supply and demand on gold constant. That's the other variable. If you have overwhelming demand for gold, it can rise even despite a rising dollar. But usually it's going to certainly help. And gold's hanging in there compared to this rip in the dollar. But this is a daily chart of the US dollar index. And, I've been talking about it for a while. And I still think a big reversal is coming. The whole global financial system just cannot tolerate. Things always get, especially currencies, things like that, there's always going to be a reversion to the mean. In fact, I'm going to get to it in a second. Japan just stepped in and intervened in the currency market to support the yen. Bank of Japan, this is the first time that they've had such an intervention in 24 years. And I'm going to get to that in a second. And it's significant because the yen is the second largest component of the dollar index. So this is a dollar index. The dollar is only, what the dollar's worth is simply relative to what it's worth against other currencies. And right now, Fed's been leading the way with the rate hikes, and so therefore our dollar's stronger. Our house is in better order than Europe. But again, all right, we all know that, but how much of that's priced into this massive rally in the dollar? And this chart says, look, these divergences work. That one wasn't the top, but it certainly was good for a big correction in the dollar. And so here's your dollar index chart. You have a beautiful uptrend line right there, nice and clean, lots of reactions there. Then we had a wedge break there. We sent it back to the trend line. We had this uptrend line we broke, and we're back testing now from below. And so the next rejection, that's your minimum target. And then if and when that trend line breaks, like I suspect it will, it's going to send the dollar all the way back down here to this longer primary uptrend line. That's what I call a high probability target. I have a high degree of confidence when we finally get some traction on a reversal in the dollar, that's where it's going. That's going to send gold exploding higher, in my opinion. I don't know if I have anything. There's a weekly chart just so you could see things going parabolic. Parabolic moves, especially in the US dollar, are unsustainable, and once you go parabolic, you tend to have a very powerful correction once the uptrend ends and you get a crowded rush for the exit. So let's just look at the other guys. Remember, as I said, the dollar index is simply sum of all its components. The euro being the largest weighting by far, 57.6 in the dollar index. That's why I'm always covering the euro, because the dollar is basically an inverse chart of the euro. Same thing, sound like a broken record, but divergence continues to build and build and build and build. And the bigger picture says the euro has to get back above here. So if it can break above this little wedge on the weekly chart, there's the downtrend line, same one I showed you on the daily. Come up here, you got major, this was long-term support. Now it's a resistance zone. And there's a trend line. So that would be comparable to the uptrend line I showed you, my target for the dollar index. And the euro will most likely hit that at the same time. And even that move there should be quite bullish for gold, especially because we're at the bottom of that right now. And then you have, of course, the yen, JPY, or USD JPY, I think it is. JPY. And here's the yen. Again, second largest component. Now it's only 13.6, but everything else starts to go down. Then you have the pound sterling next, which I'll get to, and then we'll move on. There's a longer term trend line ahead on the weekly. So this is where, quite likely, this is where the yen's headed. You can see the big candle there because the intervention. They're trying to stem. What you're seeing here, this is the dollar versus the yen. So this is the dollar rising in value against the yen. This is where the Bank of Japan stepped in today. They're trying to, they see what I see, and they're trying to trigger breakdown of that bearish rising wedge pattern because the yen's been plummeting, so they're trying to support it. And then, again, once the tide changes, that's where the yen's going, and that's going to be quite bullish for the yen, bearish for the dollar right there when that happens. And then get a reaction there, and ultimately probably come on down to the primary uptrend line right there. And then we had today the Bank of England They raised rates, what, 0.5%. There was whispers that they might match the Fed's 3/4. They didn't do it. But they did raise rates, and they have been steadily raising rates. So here's the pound against the dollar. Again, I think the pound, I think it's about 11% weighting, if memory serves me correct, against the dollar index. And it recently took out this level there, that previous low, but it also has divergence. So when this goes up, that means the pound will be rising against the dollar. So everything tells me it's coming soon. And it still may, I still suspect, and my guess, what will be the technical catalyst is the breakout of these levels. Everything I just showed you. But fundamentally, what might be the catalyst for those breakouts? Again, everything I said before. Powell realizing the folly of his ways, realizing he's trying to wean a heroin addict off heroin by skipping the methadone clinic. Where should titrate that patient down slowly off the medication, and it's not, and so therefore, like I said, I think my guess is some type of a pause or a reduction in quantitative tightening or something that stabilizes the bond market, because that's one of the biggest risks right now to the global financial system, not just the U.S. I think is what starting to become, I think, a crisis in the treasury market. That finances everything. That's how we pay our bills. That's what keeps the greatest Ponzi scheme in history, known as the U.S. dollar, going, is the fact, it's a greater fool theory. There's always going to be someone else to come in and buy it. And when everyone stops buying our bonds, and stops financing all our excessive spending and huge and increasing ballooning deficits and underfunded Social Security and all that other stuff, that's what's starting to happen now. And if that trend continues, I'm talking about treasury bonds plummeting. There's a 30-year bond. Covered it earlier. So anywho, that all kind of ties in together. So therefore, it's not a hard all in on gold and silver and precious metals, but it's something worth watching. Let me go to crypto. I think soon, at some point we have to see a return to the flight to safety assets or the alternatives. Remember, this market, for years they've used the term TINA, T-I-N-A. There is no alternative. And that's where mainly they were talking about stocks before, because interest rates were so low, nobody wanted to buy bonds. You couldn't meet your financial goals buying bonds. Crypto came around, and Bitcoin as an alternative to the U.S. dollar and to the stock market and the whole modern financial system. And let me show you Bitcoin futures. They're holding up today, and somebody asked yesterday in the closing video I did, hey, what do you still hold on to your cryptos, or what are you doing there? Because I mentioned in that video closing out longs and going short on the equities. I said I was gonna, I sold some of them, but I'm gonna hold some of them with stops in place. And I'm considering it a hedge to my equity shorts. Now, that might not make sense, because I've talked about all year, I've been emphatic about how to be long and bullish the markets is to be long and bullish crypto. But there's a chance that, number one, because of that relationship, I am short equities and long crypto, so that is a hedge itself. But we may also see cryptos holding up. Remember, the charts I showed you the other day were pretty constructive. This is a 3-month chart, 60-minute chart with 3-month candles of Bitcoin futures, BRR, and still has that divergent low. And look at this, we've been holding up much relative. We're down only slightly today, 0.16%. And so relative to the stock market, it's really holding up so far. And I think we're starting to get to that point. Now, the bottom could fall out here, because as I showed you, we're at major long-term support. This is a 6-month, 2-hour history, 2-hour candles, 6 months history, late June. A lot of support there and divergence in place, and I'm not married to it. Like I said, I'll let it go if it goes down much more. I've got a couple staggered stops to take me out on the way down if it doesn't pan out. But as of now, sitting tight with that, and especially if the market starts to melt down. There's a lot of cash, and it used to hide in treasury bonds, and now it really has nowhere to hide. But again, I think those will start to catch a bid soon, at least a short cover rally. I certainly wouldn't get married to bonds as a long-term trade. Ethereum, US dollar, and that's also holding the line right now. Remember, I said the big support is the top of that trading range. We had a multi-month trading range there with a powerful breakout, and we're back testing it, and we're still holding the line. We dipped ever so slightly, but we're really holding up again relative to the stock market. and how much. Remember, crypto is always going to move up and down more in percentage terms. So like a 1% down day in the stock market usually equates to a 3-4% move in crypto. So there's Ethereum futures, ETH, ETH USDRR, and then you have the actual crypto Ether right here. There's that trading range. There's the pop, and basically we're back testing it. So kind of hanging on by the skin of its teeth, but look, nice divergence too. A little whipsaw yesterday, all Fed related. Always, like I said, whipsaws are, you can almost count on whipsaws on a Fed day. And so far, if it can break out of this, hold this, break out of the bullish falling wedge, it could run, even if the market drops. So, and if not, let it go. Don't fall in love with anything, especially not in this market. Didn't want to cover it because I covered it in the last update, but I want to mention natural gas is breaking down pretty nice now. So you had that support here on the NG at about 750. Natural gas futures break down, starting to burn through these divergences. Still has divergences in place, but I give a higher weighting to the fact it's taken out support impulsively right there. And so that should help us get down. What is it on my yearly chart? Yeah, daily chart, daily candles when you're beautiful breakdown. That's at 750 level. I've been waiting. So there's our next sell signal. Opens the door to my final swing target from up here, which is the uptrend line and/or that 655-ish level, whatever comes in first, around there. So looking good on nat gas. Crude oil is just sitting there waiting to crack too. Literally, and I think that's what we're going to see. If I'm right about the market, and where the market's about to take it on the chin in the next couple weeks, then you're going to see forced liquidation across the board. Everything tends to get sold down in those type of markets. In the past, treasuries would rally, and like I said, I can't see them going. I can't see them dropping much more. If they do, there'll have to be some government intervention, or you're going to have a systemic blow up in the financial system, which I'm about to get to in a second with the big banks and all that stuff. So there's USO. You can see that little reaction right there. I'm going to put a line here for you. This is really the magic number right now because you have, let me color it up for you, make it yellow, whatever. You have that reaction low there and these recent reaction lows. Take that out, and if that happens, you're going to have burned through this divergence and should be a quick swoon down to my final target there, 58.60, and the uptrend line. So similar to nat gas. And you look at the futures right now, CL. So I do the video, and I'll zoom in. This is just a very short-term chart. You have a little uptrend line here. This is a 5-minute chart of crude futures, and support. You see all these recent reactions there, about $83. So if we take that out, it'll take out that uptrend line. That'll probably send us soaring down. All right, let's get to the financials, and I will wrap this up. XLF. We're going to look at maybe a couple time frames. Start on the weekly chart. These are the financials. So all I heard a few months back from the analyst about this time, not even just a few weeks ago, and that was after covering that, hit the final target on the XLF short. It goes all the way from back here. Gave it some room. Said all along that, hey, we just kept putting in marginal new divergent highs. And then finally hit T3, and we went a hair under it, put in a divergent low in reverse. And so you had a lot of analysts coming out of the woodwork on this rally saying, oh, rising rates are bullish for the financials because they make more money on the spread. Banks loan money out. Put in your money into the deposit, the checking or money market or savings. They turn around and lend it out in car loans and mortgage loans. Well, guess what? Mortgage loans are going to come to a screeching halt. The headline today was that mortgage rates just hit where is it? I don't know. Again, it was an even higher high. I think it was like 6.3 or 6.4%, highest since 2008. So you won't hear about it till after the fact because there's a lag in reporting there. But yeah, it's safe to say that that's going to certainly at least tap the brakes, if not slam the brakes on the housing market. And so where are banks making money? We know that Goldman's already just a few weeks back announced big layoffs because mergers and acquisitions are coming to a screeching halt. That activity is dying down. Banks make money gaming the stock market with their trading desks, the big banks, and they make money lending money. And if all of a sudden we hit a recession, which Powell's hell bent to put us in, yeah, it's going to put the brakes on the on the auto market. People buying cars, car loans, house loans, boats, business loans, all that good stuff. So I struggle to see where the banks are going to profit. And then from a technical perspective, it's clear that was a bear market rally. It was clearly priced in the chart. Bullish falling wedge breakout, rallied right back. I've had this shaded box forever and a day, since before the financials topped. A major topping pattern, I refer to it as. Trading range up here, about a year long. We broke it there. That was your big time sell signal. We back tested. If you missed it, you were given a golden shorting up there, and it just happened again. This is a bear market. You have that, you don't get those often. And that's the third tap. I will put good money. That's the last. You had two tests, just like you had two tests of the 200-day moving average on the S&P 500, and usually after that, once the bulls see that it's formidable resistance and another rejection, that's usually when the bottom falls out. We'll see. We're heading down. We're still just like the stock market, coming up on the recent lows. But let's look at the in the weekly chart. It was all priced in, just like the stock market. You had a big bearish rising wedge on the weekly, big negative divergence, moving down. This was major support here. First initial bear market target on the weekly, we hit it. We bounced back to the top of that trading range, and now we're back here. And if we break this, then that's going to be bearish. Let's just go through some big components. U.S. banks, and I'll cover a few of the Canadian banks. I know there's some Canadians subscribers on the website, so I'll cover those. Here's J.P. Morgan, the largest of all. So this one's very important. This is our bull market uptrend line off the 2009 lows. We broke it there. This is what I refer to as Ursa interruptus, my slang term for a bear market interrupted by the Fed. It would have, I believe, started the recession that we're now in, and started the bear market, but they wouldn't let it happen. They refused, so they threw everything that they had at it and gave that bull one last gulp of air before the bull's over. Now the bull's over, divergent high right there, just like you had a divergent high. See, it was all priced in when COVID hit, and they just pushed it up, marginal new high, divergent high, and then this is where we took it out. This was our uptrend line off the COVID lows, broken. So coming up on support, break that support. Next stop for the financials, 82.20, or I'm sorry, for JP Morgan, that is. In JP Morgan, we'll take XLF and the rest of the lot down with them because it's like the Apple of the tech sector. I'm going to see Apple going down, another 26%, and somehow seeing QQQ and Microsoft and Alphabet going up. It's just not going to happen. And then finally, at least before all said and done, I see us coming down here to that 68.50 level, and that's about another 38% downside there. On the daily chart, you're going to see this in a lot of these financials, the big banks. Just like on the weekly, you had the negative divergence leading into the highs. You have this downtrend line now. They just got rejected at JP Morgan, and it's at support as I talk right now, 111.95. So call that 112. Much below that, it's thin. You have a little spike. You had one little spike below there at the lows recently, right back up. So you take that out. Maybe it gets lucky and grabs support at 105 because that was big resistance back there. So those are your levels. If we take this out with conviction, where we're at right now, and then 105, good night, JP Morgan and the financial sector. Bank of America, same thing, daily chart here, downtrend line right there, following the divergent high, little breakout, hit that nice support right here, 23.37, but it's starting to crack that 32.84 support right there. That should send us down there pretty quickly to 29.37, and the buyers may or may not step in there, and if and when they take that out, we're going a lot lower. So that's the daily chart. That's what it looks like on the weekly. Same thing. You're going to see these banks, birds of a feather, flock together. All the banks put in these. Same thing. They had divergent highs. Their clock was pretty much punched when COVID hit, but Powell wouldn't allow it, so they gave us this last little leg up, and again, put too much morphine into the patient, and now it's I should say adrenaline. They took the patient and pumped him full of epinephrine and gave it that last little wake up there, and that's it. So we look like we're headed lower there, and I could go through each and every one. There's Wells Fargo weekly chart, daily. Wells is cracking support right here, 42.48 right now. Next stop down there about 37 and change. Morgan Stanley. But again, we're at that point where if we do start to snowball down, we may just smash through some of these support levels that are down below. Let's see. I did tell you I'd cover some Canadian banks for you. Let me just do that and then we'll wrap it up. Well, first let me cover this one, HSBC. Just look at that. HSBC's big one, Hang Seng Banking Corporation right there. Big support about 29, and if that goes, that's going to be bearish. RY, Royal Bank of Canada, as the Canucks call it, RBC. RBC has support at 91. And I think here I can show you for if you are Canadian. I think they have the shares here. Nope. Royal Bank of Canada. RYTO, there it is, yeah, TO for the Toronto Stock Exchange. So you've got a downtrend line like the American banks. They're going to follow the U.S. banks. There's some support right there at about 118.50, but let me go back to RY. There it is. So RY 91.11. So we'll call it 91. If and when that goes, which I suspect it will, 82.84 is your next support. TD, Toronto Dominion or TD Bank, head and shoulders topping pattern. There's your left shoulder, head, right shoulder. Looks like this. Left shoulder, head, right shoulder. Here's your neckline. Measured target of a head and shoulders pattern is the widest part from the head down to the neckline, which is this purple line here. That would project down to about $41 if the neckline. That's where the sell signal would come. So you want to, what you watch for with the head and shoulders, once you put in the top of a right shoulder, you want to see an impulsive move down on increasing volume. Ideally, you want to see volume increasing on the formation of the move down from the head, which you did here. See that increasing volume, and also on the right shoulder. That will help to complete the setup, and then you get a check mark when you break the neckline. Ideally, impulsively. And that's what it looks like on a weekly chart. So you can see the head and shoulders. You can also see the wedge, the big wedge we had. There was an uptrend line off the 2000 COVID lows, 2020 lows. Beautiful bearish rising wedge. Would have told you to short, get out of TD there or short it. If you missed it, you had a kickback rally right back to the breakdown point in resistance at 77, and it's been stair-stepping lower and will probably continue lower. There's Citibank. Japanese bank, Mitsubishi. You can see just about every bank in every country. So these are just, I'm on an international list of global banks now. But Bank of Nova Scotia, one more Canadian bank for you there. Weekly chart, big old negative divergence, stair-stepping lower, just like you had a divergent high there. And you also had the same thing. You had almost an identical pattern, bearish rising wedge. If you shorted that one there, you made, if you happen to take the breakdown, let me try to get it right on there. Got too many annotations. All right, before all said and done, that stock dropped about 50%. Right now, we have an identical setup, except this time around, you have the global, the central banks around the world on a tightening, pretty aggressive tightening, and we're only down 31%. So I think it's safe to say we could easily go down more on BNS and all these others. So, all right, that's it. All right, so that's the updates. We got a nice sell signal or additional sell signal in natural gas today. Crude's very close to breaking support, and so you can jump in there if it does. And then as far as the stock market goes, like I said, it's still anybody's game. Bulls can try to rally it up here, and remember they still have those 60-minute divergences in place or intact as of now. So if they can somehow pull a rabbit out of their hat and step in here and buy, and that's what it's all about. The market, as much as I'd like to think I have a crystal ball and try to look ahead, what's invisible to me and I can't see and will only know it after the fact is behind the scenes at any point in time, are there more buyers than sellers? If there are more buyers, if the sellers are right now, for at least at this point in time, washed out in the market, they're not going to be able to take it down much lower. The buyers are going to step in here, and so if they do, like I said, they've got some work to do, namely to get back above 286 with conviction, not just a brief pop. But first things first, they want to, if I was a bull, you need to foil that flag, that bearish pennant. But right now, since I started the video, it looks like right after that they pop below it. So really, like I said, you want to be safe, wait for the recent lows to get taken out, or look for a big fat red candle, and that's going to increase the odds that that's going to play out. And some point, if we start to run out those previous lows, especially if we undercut them, well, maybe we'll finally get to that point where we have that relentless selling, especially where the futures are getting sold off overnight. That's, like I said, it's been very orderly, relatively orderly bear market so far, and that's also reflected in the VIX, and in the put to call ratio. Like I said, that's what's keeping me longer term bearish, is there's no fear yet. As much as people might say they're afraid and concerned, they're not showing it. They're not capitulating. They're not buying a ton of puts, or else you'd see the VIX and the put to call ratio shoot up to levels that it has before, when we've had significant bottoms in the market. All right, I'm going to wrap it up here, and barring anything big, if anything changes, I'll do another update. Otherwise, I'll probably just wrap it up here and pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.